Last Friday, the Wall Street faced two important economic events. The first one is February's job report. The second one is a failure of the Silicon Valley Bank. Silicon Valley Bank, which is considered as the 16th largest bank in the United States, collapsed last Friday morning after a stunning 48 hours in which of a bank run and capital crisis that leads to the second largest failure of a financial institution in the United States. This is the largest failure in the last 15 years. The last one of its size was Washington Mutual Fund in 2008. Silicon Valley Bank, which is California-based, primarily used by the venture capitalists and startup, work in tech industries that is very sensitive to federal fund rate. High federal fund rate will definitely hit the financial market by undercutting the stock price, the tech price, and bringing difficulty for the banks to raising capitals. Silicon Valley Bank collapsed partly because of the Federal Reserve high interest rate hike. When the Federal Reserve interest rate were nearly zero, the bank loaded to a long-dated and seemingly low-risk treasuries. But after the Federal Reserve raised the interest rate over the last 1 year, currently the federal fund rate was 4.75. It makes the value of the assets has fallen and leaving the bank to sitting on the unrealized losses. So the Federal Reserve will probably also look for the next week, the CPI report, which will be issued on next Tuesday to make a decision. Currently, the labor market is still very hot. According to the February job report, non-firm payroll rose by 311,000 jobs on Friday. Unemployment rate rose to 3.6%. But the wage gain slowed, so we can see the labor market still very tight, and the Federal Reserve will probably make a decision after the CPI report.